Good evening, my dear friends. Hope you're all doing good. Welcome to the intensive 25 hours FM marathon. I will be giving you a 1 minute cool off time to make sure that everybody is live, whether I'm audible to all of you. Then only we'll start off with today's session. So please confirm, friends, everything is good. Wait, now I think I'm audible. Please confirm that I'm audible now. Wait. Now it will be fine. Wait, now I please confirm that I'm audible now. Good evening, my dear friends. Hope you're all doing good. So sorry for the inconvenience at the beginning. I was live, but my mic was off. I think now I'm absolutely audible to all of you. Am I right? Good evening, my dear friends. Very happy to see you all live. So, friends, we are here finally with an intensive 25-hour YouTube live marathon. Friends, I call it as a 25-hour marathon, but we'll be doing revision at a very good pace so that we are going to cover everything thoroughly in this. We'll be doing concept, we'll also be doing problems, and we'll cover the entire FM in the upcoming 5 days of time, friends. Worst scenario, something gets pending, maybe 1 day extra, you can keep a buffer in your mind. Apart from that, we'll be covering it 100% over here, friends. So, are you all ready to attend this entire session with me now, friends? If you are ready, please type a yes in the chat box. Point number two, friends, these sessions are very, very valuable. I will not keep it in YouTube for a very long time because when you keep something for free, people don't value it. This session is extremely valuable. So I want you to value it. So only because of that, I'll be keeping it in YouTube only till 15th August. That's because some of you might be doing some other revision. You might need time to go through these classes also. But once I'm done with this, 15th August, it will be removed from YouTube and it will be available only on payment basis. The reason is very simple. If you want to watch a recorded, if it is free, students have a psychology that free means something which is not worth it or not valuable. So indirectly, you also don't study, the exam results doesn't come. But if I ask a payment, that payment might not be a big one, let it be a small one also. But once you make a payment, you value it, you will use it. Once you use it, automatically you will pass the exam, and that is the ultimate objective. So live, I have kept it free. Recorded also will be available till August 15th. So if you are unable to watch it now, please watch it before August 15th, my dear friends. Now, we had actually started this revision a little bit earlier, but at that time I was doing more of a live session on a 1 hour daily. But I think many of you requested that we go live at a stretch. So I stopped that. So I just want to go and check where we have actually reached in that part, so we can, take it forward from there. So let me take Tarun Jagdish YouTube channel. Let me take live. So here we had already learned about two-stage dividend discount model, and I think multiple more things we have learned live. Free Modigliani Miller, we have learned Walters model, we have learned Gordon's model, we have learned how to value an asset, we have learned NPV. So I think we have learned till here right now, correct? Gordon's model. And last thing that we learned over here was two-stage dividend discount model. We have also learned about Modigliani Miller. So friends, whatever is already taught, I'm not taking the same thing again. I'll give you a concept revision on that, and then we'll start doing the problems on that one. Okay. So today being the first day, let us start with an easy topic. Okay. And these notes also, I'll make it available to all of you. I'm keeping the name of the notes as 25-hour marathon. Okay. So friends, are you all ready? Please type ready in the chat box. Shall we begin? All right. First, we'll start with a basic chapter, dividend policy, and then we will slowly take it forward to the other chapters also. Everyone clear? So here we'll be doing ODBE questions, friends. I have two books. One is the Mastery book and the other one is the ODBE book, correct? The ODBE book covers less questions, but it covers all the areas. So today we are going to do which book, friends? We are going to do ODBE book, okay? And if you find this class is useful, please like this video and share it with at least 2 of your friends, so that they can also benefit from these classes. Okay. So yes, first we'll start with dividend policy. Here the main things for you to learn will be, you'll have to learn about Walters model. You will have to learn about Gordon's model. And you will also have to learn about Modigliani Miller. These are the 3 main approaches over here. Gordon's model, the formula is P0 is equal to D1 divided by KE minus G, where D1 is the dividend next year, KE is the cost of equity, and G is growth. Friends, I'm not elaborating much on this because we have already covered this in my YouTube itself. You just have to go to YouTube live. You'll get detailed concept videos for all these things. Walters model, the formula that we learned was D by KE plus E minus D into R by KE whole divided by KE. Modigliani Miller, the formula was NP0 plus P1 into N plus M plus E minus I whole divided by 1 plus KE. Okay. Sorry, I made a small mistake here. This is equal to what? This is equal to NP0. Everyone clear with this part? So friends, all the 3 of the formulas are explaining one and the same thing. This is a perpetuity formula. Cash flow divided by discount factor minus growth. So that is the present value of future cash flows. Or friends, we had also learned a very, very important concept earlier, that value of any asset is present value of future cash flows which the asset can generate. Everybody clear? So friends, we learned about 3 models over here. What is the first one? Walters model, Gordon's model, Modigliani Miller, and we learned that value of any asset is nothing but it is the present value of future cash flows. Are you all clear with all these formulas, friends? If you are clear, please type a thumbs up or a yes in the chat box. Okay, so can I start with a question on this one now, friends? If you're all done understanding these concepts, if you want to get more details about these 3 videos alone, go to my live. It's here. M&M, I have given a full detailed video in 30 minutes. Even Walters model detailed lecture is given over here. You can watch these videos for details. Now we are doing a crisp marathon revision, friends. Okay, so now what we will do is, since you're done with the introduction part, we will directly move into the problem solving part. Shall we move into the problem solving part, friends? Yes. So here you have the ODBE book. This only contains the past examination question, friends. So once we do the past exam questions, automatically we will get very good grip on these questions. Everybody clear? So let us do the first question from the chapter of dividend decision. Everyone ready? Okay. All right. So I think everything is sorted here. Yes. So friends, let us do question number 1 from dividend decision. Rambo Limited. Friends, when you do a question, I'll give a heading over here. Question number 1. Any question you start with, you will start with working note number 1, basic data. Okay. Rambo Limited has 1 lakh equity shares. So I'll write down over here point number A. Number of shares is equal to 1 lakh shares. Okay. Point number B. The current market price of the share is how much rupees, friends? 100 rupees. So current market price per share is 100 rupees per share. All right. Company is planning to pay a dividend of how much rupees per share? 10 rupees per share. Your DPS is equal to how much, friends? 10 rupee per share. The required rate of return or KE is given over here as how much percentage? It is given as 15%. Based on Modigliani Miller, they are asking you to calculate the master market price of the share of the company when the recommended dividend is declared or dividend is not declared. This is the question. How many new shares are to be issued? 1 minute. Are to be issued at the end of the company if there is an earnings of 40 lakhs. If you have an earnings of 40 lakhs, and point number F, you have an investment budget of 50 lakhs. So like this, friends, once you write the basic data, you will understand the question thoroughly. Once you understand the question thoroughly, you will get answers automatically. Can you please write down till here in your books? Hi, Liam, you want the soft copy, right? I will arrange the soft copy for all of you. Okay. I will tell you how to arrange it. First, you write down. We'll do this question, then I will share the soft copy with all of you. All right. Yes. Please write down the basic data in your books. All right. And please write down along with me, friends. So because I'll be then giving you the notes, this PDF also will be shared with all of you. At the end of the 5-day class, the entire one single PDF will be given to all of you. Okay. Right. So once you're done writing the basic data, now they want you to solve it using Modigliani Miller. So everyone tell me what is the formula for Modigliani Miller? NP0 is equal to P1 into N plus M plus E minus I whole divided by 1 plus KE. Okay. So when you solve this, we actually go by 3 steps. Step number 1 over here will be calculate P1. Step number 2 over here will be calculate M. And then you go to step number 3 where you are actually trying to solve the equation. Everybody clear with this part? So now when you're doing P1, P1 is found out using the formula P0 into 1 plus KE. Last year price plus investor's expectation will give you P1. M means the new number of shares to be issued. So the new number of shares to be issued is found out using the formula I plus D minus E whole divided by 1 plus KE. I'll explain the logic of each and every one of this separately when we are solving it together now. All right. For time being, just scribble down these formulas in your books. I'll give you 1 minute time. Can you quickly write down this in your books, friends? And also write along with me so that we can save the time and we can do more number of questions here. Okay. All right, friends. I believe you're all done writing till here now. Okay. So now let us do it. I'll write down over here situation number 1. Dividend declared. Friends, when dividend is declared, I will write down step number 1. What is step number 1? Everyone tell me. I will be calculating P1. What is the formula for P1? Everyone tell me. Keep on talking, okay? P0 plus KE minus D. So I had to P0 into 1 plus KE minus D. Dividend also will come down. I had forgotten to inform that over here. 1 plus KE minus D. Now everyone tell me, what is the P0 that is given in the question? Price 0 is how much? 100 rupees. Into 1 plus, what is the KE given in the question? 15 percentage. Minus D. D means what? Dividend. So what is the dividend that you have over here? 10. So now tell me friends, what is the answer? You get 115 minus 10. Do you get the P1 as 105? Now I will write down step number 2. What is step number 2? Everyone tell me. Calculate M. Am I right? Yes. Calculate M. So when you are calculating M, here I'll put the table what I gave earlier. What was the table? I. I means what? Investment. So everyone tell me how much is the investment that is told in the question? 50 lakhs plus D. D is nothing but dividend. So everyone tell me how much is the dividend that is told over here? 10 rupee per share. How many shares are there? 1 lakh shares are there. So what is 10 lakh? 10 rupee into 1 lakh shares. Do you get the answer as 10 lakhs? So friends, what is your total outlay that you have over here? Is that turning out to be 60 lakhs? Less earnings. Earnings is your inflow. Am I right? How much is your earnings that you have over here? Is that turning out to be 40 lakhs? Correct? So now tell me, when this is reduced, what is the fund shortage that you are having over here? Friends, I am indirectly telling you the logic of this M. Okay? So what is the fund shortage that you have over here? Do you have a shortage of 20 lakhs? I hope I have written the question correctly. Investment budget is 50 lakh and the earnings is 40 lakh. They are planning to pay a dividend of 10 rupee per share on 1 lakh is going to be 10 lakhs. Absolutely correct. So your outlay was 60, earnings was 40, of fund shortage is 20. Now when you have a fund shortage, this fund shortage can be raised either by way of equity or it can be raised by way of debt. Modigliani Miller assumes that everything is raised only by way of equity. They will use P1. What is P1 over here? Is it 105 rupees per share? Am I right? So now tell me, from this, can I find out what will be the number of shares to be issued over here, friends? $20 lakh divided by 105, correct? Do I get the answer as 19,047.62 shares? Everybody clear with this part now? Alright. So once you get this answer, you got calculate P1, then you got calculate M. Everyone clear so far? Then I will write down step number 3. Step number 3, solve the equation. So here you have two parts of the equation. First one is LHS. What is LHS? NP0 or number of shares into price today. So earlier you had 1 lakh shares into the price today was 100 rupees per share. From that, do you get the answer as 100 lakh rupees, friends? Correct? Now I will put the RHS. RHS is nothing but P1. How much is the P1 that you have? 105 into M plus N. Existing number of shares is 1 lakh plus the new number of shares is 19,047. Okay, this is the total value after 1 year plus earnings. What is the earnings that you have over here? 40 lakhs plus E minus I. How much is the investment you are making? 50 lakhs whole divided by 1 plus KE. Okay, so it's the present value of future cash flows. Value of an asset is nothing but it is the present value of future cash flows. Everybody clear so far? Okay, so now let's work it out. 1,19,047.62 into 105, that's 125 lakhs plus 40 minus 50 divided by 1.15. Do it and see, friends, you will get the answer as exactly 100 lakh rupees. Is this the same answer you got earlier also? Take a minute, write down this in your books. I hope the pace is comfortable, friends. Tell me if I should increase the pace or decrease the pace. However you tell me, we will do it according to that. Are you all done, friends? Can I go to the next part? If you are comfortable, please put a thumbs up, love, or any one message so that I can get a flow that we are all at the right pace. All right, friends. So we are done with part one. What was part one? Dividend declared. Now I will go to part number two, or I'll call it as situation number two. What is situation number two, friends? Dividend not declared. Okay. So now, friends, if dividend is not declared, again we will have the three steps. What is step number one? Everyone tell me. P1. How do you find out P1 now? P0 into 1 plus KE minus D. Everybody clear? Fine. So what is P0 that you have over here now? P0 is going to be 100 into 1 plus 15%. Now if dividend is not declared, your D will become 0. So do you get the answer as 115 over here, friends? Correct? Now I will go to step number 2. What is step number 2? Calculate M. How do you work out M, friends? M is nothing but investment plus, so I'll just maybe put it here. Step 2, calculate M. So there I'll write point number A will be what? It will be investment. How much is the investment that you have over here? Everyone tell me. 50 lakhs, right? Plus dividend, that's an outflow for the company. Here the dividend is going to be 0. So what is your total outflow that you get over here? 50 lakhs less. What is the second part that they have told over here? Less earnings. What is earnings? Earnings is your inflow, correct? How much is your earnings that you have over here? I think it is 40 lakhs. So what is your fund shortage now? Is that turning out to be 10 lakhs, friends? Correct? 10 lakh is the fund shortage. Then you have P1. At what price are we issuing it? 115 rupees per share. So what is 10 lakh divided by 115? Do you get the answer as 8695.65? I hope I have taken everything correctly. Investment is 50 lakhs only, right? Yes, earnings is 40 lakh. Dividend will be 0. So you will get 8695.65. This looks to be correct. All right. Once I get this, then I will go to step number 3. That is solving the equation. There are two parts. What is the first part? LHS. What is LHS? Everyone tell me. NP0. So what is NP0? Everyone tell me. Number of shares. Number of shares will be initially 100 lakhs. Correct? 1 lakh into 100, that is equal to 100 lakhs. What is the second part? RHS. How do you do RHS? P1. What is your P1? 115 into 1 lakh plus 8695.65 plus earnings. What is the earnings that you have over here? Everyone tell me. How much is the earnings that you have? 40 lakhs? Yeah. Minus investment is how much? 50 lakhs. Whole divided by 1.15. 1 lakh. My dear friends, you again get the answer as 100 lakhs itself. Hence, proven that whether you declare dividend or you don't declare dividend, your price will remain the same. Can you please write down this also in your books now, friends? This is one thing at which Modigliani Miller was very, very good here. He will convince you that whether you do it or you don't do it, the price will always remain the same. Always he will do that. Are you all clear so far, friends? Alright, I'm going to the next page now. Alright, so friends, we are done with this one question on Modigliani Miller, where he correctly proves that whether you declare dividend or you don't declare dividend, the price of the company will remain the same. Everyone clear so far? Yes, so we are done with this question. Can I go to the next question now, friends? Friends, entire solution is given here. But before that, you want the material in your this thing, right? Friends, to get the material, you will have to install my app. So I'll give you the access to the material. Point number one, please, if you are using an Android phone, will take 5 minutes so that you can install the app now. Take the Android phone, search for Tarun Jagdish. Okay, and if you're using an iPhone, you search for an app called as Class Plus. Inside Class Plus, they will ask you for an ORG code. There you go and enter the ORG code as ELEVM. Okay, I'll give you 5 minutes time. Let's install the app first. Okay, please install this. I'll wait for you. Please install this. Done installing, friends? Once you install this app, there is a batch which I had created for you, Inter FM September 2026. In this app, you have the material also available. So this is the app. The batch code is SCP26. So once you're done installing the app, they will have our option called as batches below. Just check. You will have an option called as batches. You have to click on batches. Once you click on batches, on the bottom right, you will see a plus symbol, something like this in blue color. Click on that and enter. They'll ask you for a batch code. The batch code is SCP26. Batch code is SCP-26. The moment you give that, you will get access to the entire thing. All right. Anybody having doubts, please let me know. This is how you will install the app in your phone. And here, once you are giving access, I will be able to see the access over here. And I can arrange access for all of you. So far, no request. Already 40 students have enrolled in this batch. Yes, Krishnendu, I got your request. Yes. So Krishnendu, the moment. Okay, are you able to see the access? Are you able to see it now? So now here, if you go into content, where in the content you have ODB book and you have the mastery book also. Everybody clear? Whereas if you are trying to look for test, you just have to click on test. I have created chapter wise test also here for all of you friends. You can attend those tests and this will help you a lot. Each of these exams, if you write, you'll get very good marks in the exam. Now I think capital structure is the last one that we made. Only 3 people have written. They scored very good marks. Selamani, Zamkrishna, Binta. Great job. Keep it up. I've got one more request. Let me add them also. Pooja. I have added you also, Pooja. Others, you can keep giving the request. I will add you. All right. And if anybody is having any doubts, you can always WhatsApp me. My WhatsApp number is also given over here. You can see my WhatsApp number. Correct? Fine. Can I go to the next part now, friends? Okay. Yeah. Okay. Laptop. Leah, if you're using laptop, you have to use a website version. Click on this. But website, you won't be able to get the material, Leah. You use your laptop for classes, but for mobile, if you can get one mobile phone, I can arrange the ODB book access for you. Otherwise, you have to WhatsApp me. I'll have to arrange a soft copy by some other means for you. WhatsApp me. I'll get in touch with you, Leah. Okay. All right. I'm going to the next part now. So we are done with question number 1. Okay. Now let us go to question number 2. Are you all ready, friends? Question number 2, ODB book. Working note number 1, basic data. HM Limited is listed on Bombay Stock Exchange, which is currently being evaluated by Mr. A. Okay, so HM is listed in the Bombay Stock Exchange. There's a company called as HM Limited. It is listed in BSE. BSE is the Bombay Stock Exchange, which is currently being evaluated by Mr. A. This is being evaluated by Mr. A. Every question, friends, we have to spend some time understanding the question. That's very, very important. Okay. Now, the company generally gave a quarterly interim dividend of 2.5 rupee per share is the last dividend declared. I'll just write down. Again, I'll put a heading called as basic data. Dividend per annum. They're declaring a dividend per annum of 2.5 into 4. 2.5 per quarter. So per year it will be how much? 10 rupee per share. This is what we call it as D0, as it is the last paid dividend. Everybody clear with this part? The company's sales are growing by 20% on a 5-year CRJS basis. Growth is right now given as how much? 20%. Everyone clear? 5-year compounded annual growth rate. However, the company expects the following retentions amount against all probabilities as given over here. Rate of return is 10%. ROE of the company is how much? 10%. This is also called as what? It is called as R. Point number D, down they have given you situation, probability, retention ratio. Friends, when you see retention ratio and probability, the moment you multiply this, you will get the expected retention ratio. So I'll write down the next one. Weighted average retention ratio. That will be 50 into 30% plus 60 into 40% plus 50 into 30%. 15, 24. So 24 plus 15, 34, 39, 49, 50, 54 percentage is your retention ratio. So friends, we have also learned one thing, that G is actually equal to BR. Am I right? Growth is equal to retention ratio into rate of return. Therefore, growth will be equal to 10% into 54 percentage. Or do I get the growth over here as 5.4 percentage? Based on the formula, the growth rate is how much? 5.4. But the question has already given you a growth of how much percentage, friends? 20 percentage. Everybody clear so far? So I think we have put the basic data so far. Everyone take 1 minute. Can you write down this basic data in your books? All right, friends. Are you all done writing till here in your books now? Okay. Can I go to the next part now? All right. So company sales growth is given like this. Current RF is 3.75. Let's put the basic data here itself. Point number F. RF is 3.75 percentage. Beta is equal to 1.2. And company has a risk premium. What is the risk premium the company is having? That is equal to 4.25%. Everybody clear with this part? All right. So friends, from the data that we have written over here right now, G, ROE, weighted average retention ratio, and growth, etc. From this data, now I will go to working note number 2. We can find out some hidden information, friends. What are the hidden information we can write down? Working note number 2. Analysis. Okay, so here we'll find out some hidden information. Point number 1, they have told dividend we got 10, growth we have got RF plus beta into RM minus RF will give us a KE. Okay, I think that we can find out here itself. KE is equal to RF plus beta into RM minus RF. So everyone tell me what is the answer that you get over here now? Do you get the answer as 8.85 percentage? Correct? That is going to be your KE. Okay. Expected return. Everyone clear with this part? Now they're asking you to calculate the current market price using Gordon's model. So working note number 2, I will not write down as analysis. I will write down over here price using what model? Using Gordon's model. So what is the formula for Gordon's model, friends? P0 is equal to D1 divided by KE minus G. Therefore, D1 will be equal to what, friends? We have D0 as 10 into 1 plus growth. We have got the growth as 5.4 percentage. The 20% is given for your confusion only, friends. So now tell me what is 10 plus 5.4%? Do I get the answer as 10.54? D1. What about KE? Let's go and check the KE now. What is the KE that you got over here? 8.85 percentage. D1 divided by KE minus G. Growth, we have got the answer as 5.40%. Therefore, P0 is equal to 10.54 divided by 8.85 minus 5.4 percentage. Everybody clear so far? Do you get the answer as 305.5 rupees per share, my dear friends, based on this? Fantastic. Write down all this in your books, friends. I'll give you 1 minute time. Once you are confirmed, I'll go to the next part. And also let me know, friends, is the pace comfortable? Shall I go in the same pace? Shall I decrease the pace or increase the pace? Please put in the comment box. Friends, I think the screen went black. Sorry for that. Please write down this in your books. Please write down. So you got KE over here, you got growth over here, and you got D0 over here, correct? All right, I'm going to the next page now. Please write down this also in your books. All right, friends. I believe you are all done writing. Let's check the solution that is given over here now. One moment. 5.4. Yes, we got the same answer, friends. 305.51. Everyone clear with this part? So we are done with this question also. Clear with this part? So we are done with this question. Audio, video, everything clear, right, friends? Can I go to the next question now? Okay. Ready? Right. Question number 3, ODB book, dividend policy. Working note number 1, basic data. These are all past exam questions, friends. Okay. Point number A. X Limited is a multinational company. Current market price per share is 2185. So I'll write down P0 is equal to 2185. Point number B. During the financial year, the company paid 140 rupees as dividend per share. So D0 is how much? 140 rupees per share. Okay. And company is expected to grow at 12% per annum. Grow at 12% per annum for the next 4 years, then 5% per annum. So 12% per annum for 4 years, or we call it as the high growth phase. High growth phase. Everybody clear? Next point. 5% per annum for an indefinite period. So a perpetual growth rate. That is going to be 5% per annum. Expected rate of the shareholder is 18%. So KE is equal to 18%. Find out the intrinsic value per share. That is the first question what they are asking you over here. So fine, P0 is given, D0 is given, data is given. They want you to find out the intrinsic value and they want you to know whether the price is undervalued or overvalued. Okay. So friends, this is a very simple question on two-stage dividend discount model. I'll now write down working note number 2. Working note number 2. Price of the share using two-stage dividend discount model. All right, so here I'll write down. I'll draw a table first. Now, everyone tell me how much is D0? 140. All right. Then they are telling it's growing at 12% per annum. So D1 will be 156.8. D2 will be again 12% per annum, right? 175.61. D3 will be 196.69. D4 will be 220.29. After this, your D5 will become stable. What is the stable growth rate? 5%. 231.30. Everybody clear with this part? So then what we do is this first 4 year, what you get over here is what we call it as a high growth phase. This is what you call it as a stable growth phase. Okay, so I'll now draw a table over here, friends, and the table will go like this. One moment. The table will go like this. Here, cash flow, discount factor, discounted cash flow. So now tell me what is the discounting factor that is told over here? 18%. Correct. Now here, year 1 will be what? Year 1, what is the cash flow you have? 156.8. Year 2, 175.6. Year 3, 196.69. Year 4, 220.29. And year 5, you'll have 231. Now, year 5, you won't write down like that. Year 5, we'll do it in a different way. These are the high growth cash flows, correct? Right side, I will give present value of perpetual cash flow. So here the formula would be what? Price 4 is equal to D5 divided by KE minus G, right? So D5 is how much? 231.3. divided by KE, that is 18%, minus growth is how much percentage? 5 percentage, correct? So when I do D5 divided by KE minus G, friends, I will get the price at the end of the fourth year. 1780. Everybody clear with this part? So now with this 0.8474, 0.718, 0.6086, 0.515, 0.437. Do you get 132.80? 126.08, 197.29, 113.44, 777.86. One three four 7.47. All right, friends. So that is the value using two-stage dividend discount model. Shall we go and cross-check? They've got 1408. Let me see if I made some rounding of difference. 132 is correct. First one is correct. 126 is also correct. 197 I got. Okay, I think I made a mistake here. Friends, it's not 197. 196.69 into. This is 119.58. Those are correction, friends. 1 minute. One two six 9.76. All right, let's check now. Again, there's a mistake. 113.44 is done. Last one, they got 916. Let's check how they got 916. They got 1779. Yeah, we got the same number. 1779. Okay, I've made a mistake again over here. This is year 4. Year 4 PV factor is 0.515, friends. Sorry, I've made a small two technical mistakes I've made over here. Please correct that part. So 916.7. So when you put this, your answer will be 1408, friends. So this is the price using what model, friends? Two-stage dividend discount models. Can you write down this in your book, friends? Write down till here first. Yes, friends. Pooja, you're telling if they have given come dividend, how to calculate dividend. Where have they given come dividend, Pooja? I don't think that's given over here. They normally don't use the terminology here. So, friends, we have got first part, we got the answer as 1408. Now I will write down the next working note heading. Action to be taken. So, everyone tell me what is the theoretical price that you all have got over here? 1408. Point number B. What is the actual price that you have paid over here, friends? What is the actual price? 2185. So, friends, actual price is 2185. Theoretically, the price should be 1408. So, can I say the actual price is overvalued? Price should be 1408. Very soon, the price is going to fall down to 1408, friends. Correct? Actual price is overvalued. So, that is ex dividend, come dividend. Come dividend means the price of the share, including dividend. Ex dividend means price of the share after declaring dividend. But that has nothing to do with this question. That will come in the market price. Here, the price that is shown is after giving all the dividends. So, you can also call it as ex dividend if required. Okay. Thank you, Pooja, for the fourth year discounting factor point. Yes, friends. So we are done with this question also. Can I go to the next one? Okay. Ready, friends? All right. Question number 4, ODB book, dividend policy chapter. It's coming on page number, I think page number 5. It's coming on page number 5, friends. Okay. Working note number 1, basic data. Working note number 1, basic data. Question number 4. Point number A, earnings. Everyone tell me what is the earnings they have told over here. Is it 30 rupees per share? Point number B, dividend. So what is the dividend that you get over here? 9 rupee per share. Cost of capital is nothing but KE. So what is the KE that you get over here? 15%. Point number D is what? IRR. What is the IRR that you have over here? Is it turning out to be 20%, friends? All right. Earnings is given. Dividend is also given. KE is given. And the IRR is also given over here. From this data, they are asking you to find out the price using Gordon's model and the price using Walter's model. Can I start with Gordon's model, friends? Working note number 2. Price using Gordon's model. So everyone tell me now, friends, if you are doing it using Gordon's model, what is the formula that you will use over here? P0 is equal to D1 divided by KE minus D. Correct? For that, D1 will be nothing but D0 into 1 plus G. Correct? Now for this, we need to get G first. Correct? G or growth rate. So what is the formula for growth rate that we have learned? G is equal to BR, or in other words, here 9 by 30 will give you the payout ratio. So I'll write down below this. Payout ratio will be 9 by 30. That is 30%. Therefore, your retention ratio will be how much, friends? Will it turn out to be 70%? So therefore, G is equal to B, that is retention ratio, into rate of return is directly given as 20. So when you do like this, do you get the answer as 14% over here, friends? Everybody clear with this part? Okay. So G is we got G. So once you get G, then I can find out D1 also. Let me highlight. G 14%. D1 is what? D0 is 9 rupee into 1 plus G. Do you get the answer as 10.26 over here? Correct. And KE is directly given as 15. Now friends, it's easy for me. What I'll write down over here? P0 is equal to D1 divided by KE minus G. Do I get the answer as 1026 over here? Shall I cross check the answer with the solution book, friends? 1026. We have got the right answer. Can you write down till here in your books now? Yes, friends. Are you all done with Gordon's model? Once you're done with Gordon's model, can we do it using Walter's model now? I'll put it here itself because there's some space available here. I'll do it here itself. Okay. I'll write down the next working note heading. Walter's model. That is P0 is equal to D by KE plus E minus D into R by K whole divided by K, or D will be 9. So it will be 9 divided by 15 percentage plus E minus D, that is 30 minus 9 will be 21. It will be 21 into R is 0.2 divided by 0.15 whole divided by 0.15. Do you get the number as 60 over here plus 186.66, or in other words, you get the answer as 246.66 will be the answer. Shall we cross check, friends? Yes, you got the same answer. So friends, what is the price you're getting under Gordon's model? 1026. Same thing under Walter's model, you get the price as only 246.66. Is everybody clear so far? If you are clear, please type a thumbs up in the chat box. We are done with this question also. Friends, how is the movement of the class? Are you all comfortable so far? In 1 hour, we have done quite a lot of questions of dividend policy. Indirectly, it covered Gordon model, we covered Walters, we covered Modigliani Miller, we also covered two-stage dividend discount model prints, right? And these are all past exam questions. What we have done is all past exam questions. So we are actually done with this chapter. Okay, you want a 5 minute school of time? I think we can take a short 5 minute school of time and then we can start with leverages. Will that be okay? Right? All right. So friends, I'll just put a short break. What the time now? 5:12 is it? We'll take a 5 minute school of time. So I'll just write down over here. Break will resume at what is it? I'm not stopping the live. Let the live be open. We'll start back at 5:20 p.m. All right. We'll take a short break and we will resume back. All right, friends. So see you back at 5:20 p.m. Right now the time is 5:12. Okay. Thank you, friends. Thank you so much. Friends, I'm back. Am I audible to all of you? Hmm. Please confirm that you all can hear me. Then we can start with the next chapter of leverages. Just type a yes in the chat box and we'll quickly start off with the next chapter. All right, friends. Can I begin now? All right. Let's start with the next chapter, leverages. Friends, let me first give you an overview of this chapter of leverages. It's a very simple chapter. In this, you mainly have to find out three types of leverages. The first one is what you call it as operating leverage. The second one is what you call it as financial leverage. And the last one is what you call it as combined leverage. Okay, everyone repeat with me what is the first one? Operating, then you have financial, and last one is combined. Can I start with this now, friends? All right. So, friends, let's start with a simple example on leverages now. Particulars. Let us say we are talking about 2 years, 2025 and 2026. Okay. Revenue of the company is, let us say, 100 crore. Now this company has a variable cost of 60 crore. Therefore, what is the contribution of this company? 40 crore. From this, I'll reduce the fixed cost. So let us say the fixed cost is turning out to be another 10 crore. So once you reduce this, you get the EBIT. What is the EBIT you get over here? 30 crore. On this EBIT, you will be reducing the interest. Let us say that is 10 crore again. You get earnings before tax that turns out to be how much? 20 crore. On this 20 crore, you will have a tax that will be 30% or it will be 6 crore. Once you reduce this, you will get earnings after tax that will turn out to be how much? 14 crore. Okay. Now, let us say HIJ, you have number of shares outstanding is 1 crore share. So you get the earnings per share as how much over here? Your EPS will be 14 rupees per share. Are you all clear with the concept so far? Next year, suppose the revenue goes up to 150 crore. Revenue has gone up. So automatically what will happen? Your variable cost will also go up, correct? You get a contribution of 60 crore. This will become 90 crore. Fixed cost will remain the same. Your EBIT 50 crore. You'll pay the same interest. EBT will become 40 crore. 30% will be 12 crore. You reduce this, you get 28 crore. 1 crore share is there, so you get 28 rupees per share. Friends, this is the basic data. I'll give you 1 minute. Can you write down this in your books now? All right, friends. Once you're done writing this, with this one data, I can explain to you the entire concept of operating leverage, the financial leverage, and combined leverage. Shall we now go to the next part now, friends? Are you all ready? Here, we have a contribution, correct? And down you have EBIT. Then here you have EBT. These are the three crucial points using which we find out the operating leverage, financial leverage, and combined leverage. All right. So let's start with the first one. What is the first one over here? First one is operating leverage. Operating leverage. So when you start off with operating leverage, the formula for operating leverage is EBIT, sorry, contribution divided by EBIT. So everyone tell me in this question, how much is the contribution that we have got? 40. EBIT is how much? 30. So what is 40 divided by 30? Everyone tell me. Do you get the answer as 1.33 times? Or friends, the logic of this is that, okay, my company, the logic I'm giving you over here, my company earns contribution, which is 1.33 times my EBIT. Everybody clear with this part now? This is the first one. I'll show you different formulas later on. First, let's understand the derivation with one formula. Everyone clear? Now I will teach you the second concept. The second concept over here is called as financial leverage. Financial leverage. So friends, what is the first one? Contribution divided by EBIT. What is the second one is financial leverage. Here the formula is going to be EBIT divided by EBT. So now tell me friends, how much is your EBIT that you get over here? Your EBIT is, 1 minute, 30 crore and the other one is 20 crore. So can you tell me what is 30 divided by 20? Do I get the answer as 1.5 times? Or the logic of this 1.5 times is that my company's EBIT is 1.5 times. My company's EBIT is 1.5 times its EBT. Everybody clear with this part? So we got two things, friends. One, we got operating leverage. Other one, we got financial leverage. Now the last one is what they call it as a combined leverage. Combined leverage. So what they do for combined leverage is that I'll show you. When I did operating leverage, it was contribution divided by EBIT, correct? When I did financial leverage, it was this divided by this, correct? Now combined leverage will be this divided by this. So I'll take a fresh page now. Here I'll write down the first formula. Formula number 1 over here will be equal to contribution divided by EBT. Or how much is my contribution, friends? 40. Divided by my EBT is how much? 20. So do I get the answer as 2 times? Or the logic is my company's contribution is 2 times its earnings before tax. Everybody clear so far? Now there is also one more formula which I'll call it as formula 2. Formula 2, degree of combined leverage DCL is equal to degree of operating leverage into degree of financial leverage. So now tell me what is the degree of operating leverage that you have over here? 1.33 into what? 1.50. So everyone tell me what is 1.33 into 1.50? Do you get the answer as 2 over here also? So whether you use formula 1 or formula 2, your answer will remain the same. Can you write down this in your books now? Friends, I hope the class is going comfortable. If you are facing any difficulty, WhatsApp me or let me know. Okay. If you are comfortable, please put a thumbs up in the chat box. All right, friends. Finish writing this, then I'll go to the next part. All right, friends. So I believe you're all done writing till here. So we learned about operating, we learned about financial, and we also learned about combined leverage. Am I right? Now, friends, I'll show you another way of getting the same answer. What I'll do now is I will take the percentage change over here. So tell me from 100 to 150 when there is an increase. Do you get an increase over here as plus 50 percentage? Correct? Contribution also indirectly will go up by plus 50%. Or the moral of the story is if revenue goes up by 50, by default your contribution will also go up by 50% only because the percentage is the same. Okay. What about EBIT? 30 has become 50. So that is going up by 66.66%. Correct. Now, what about EBT? EBT is going up by how much? 100%. All right. What about earnings after tax? 14 to 28 crore. Again, it is going up by 100%. EPS is also going up by 100%. So, friends, one lesson that you need to keep in your mind now is that percentage change in EBT is 100, 100, 100. What about EBIT is 66.66. Contribution is 50 and revenue is also how much? It is 50. Everyone clear with this part now? All right. So I think we are done with this one particular example so far. Now I will show you the answer in a different way. I'll put a table now. All right. Here now I will write down the names. We already learned about degree of operating leverage, degree of financial leverage, and degree of combined leverage. Yes or no? For operating leverage, what was our first formula? Contribution divided by EBIT. Correct? So when I did that, did I get the answer as 1.33 times? This is what I'll call it as formula number 1. I can also give you formula number 2 now. Friends, now listen carefully. If it is percentage change in contribution by EBIT, I'll reverse the formula and I'll put it over here as percentage change in EBIT divided by percentage change in EBIT. I just made it opposite way. So friends, what is the percentage change in EBIT? 66.66, correct? Okay. Divided by percentage change in, wait, I think I wrote the formula wrong. It will be percentage change in contribution, right? So tell me now, what is the percentage change in contribution that you get over here? Do you get the number as 50% over here? Am I right? So here what will happen is the formula will turn out to be 66.66% divided by 50%, or you will get exactly the same answer, my dear friends. Now, one more important thing is that we have learned that whatever is the percentage change in contribution, the same change will also happen in the sales. So we call it as percentage change in contribution divided by sales. Everyone clear with this part? All right. That is part number 1. Point number 2, we can also do degree of financial leverage. What is the formula we learned over here? EBIT divided by EBD. 30 by 20. 1.5. How will you change it now, friends? Percentage change in EBT. Now tell me, EBT, what is the percentage change? 100. EAC and EPS is also 100 only. So here I can do either EBT slash I can do EPS. Whole divided by percentage change in either EBIT. I think EBIT only. Okay. So here you get 100% divided by 66.66%. Do you get the answer as 1.50 times? All right. Are you all done with this part? Now combined leverage. What was the first formula? Contribution divided by EBT, or 40 divided by 20. You got the answer as 2. Yes or no? I can now just make it topsy-turvy. So what will it come over here? Percentage change in either EBT or EPS or EAT also. Okay. Whole divided by percentage change in either contribution, or if I put sales, it will turn out to be 100% divided by 50%. Again, you will get the answer as 2 only over here, friends. So like this, now we have learned 6 different formulas for DOL, DFL and DCL together. Can you write down this in your books now, friends? Friends, I am audible to all of you, right? Please confirm that you can hear me. Hold on. I can see that it's audible here, but I am not able to check it in my phone. Is there something wrong with my phone? I'm audible, right? It must be some issues with my phone then. Okay, please write this down in your books, friends. Fine, friends. Are you all done writing till here, friends? So we are done with the entire concept of operating leverage, financial leverage, and combined leverage. This chapter is very small, one concept, and then we do all the problems. Okay. So everyone done with this concept? Perfect. Now, friends, can I go and do questions on this concept? Question number 5, ODB book, a question on leverages. Working note number 1, basic data. Basic data. The capital structure of ABC Limited for the year ended 31st March 2022 is given below. So equity share capital 20 lakh. That is 100 rupees. Point number B. So if the face value is 100 rupees, from this, can I go and find out the number of shares, friends? 100 rupee would mean, I think, 20,000 shares. How did I get this 20,000 shares? Everyone tell me. It was nothing but 20 lakh divided by 100. Everybody clear with this part? Next thing. 10% debentures is again having a value of 20 lakhs. All right. And in bracket, they have told 100 rupee each. From this, can I go and find out the number of debentures now? That will also turn out to be 20,000 debentures. How did I get this answer, friends? C divided by 100. Everyone clear with this part? Next. Okay, once you got the number of debentures, they have also told 10% interest. So from this, can I find out the interest amount on debentures? Will that turn out to be 2 lakh rupees? How did I get this 2 lakh rupees? Everyone tell me. 20 lakh into how much percentage? Into 10 percentage. Everybody clear with this part? Now, during the year 21-22, the sales decreased to 1 lakh units as compared to the previous year 1 lakh 20. Hold on. So we have data about current year and previous year. Before that, can you please quickly write down this in your book? All right, friends. I believe you are all done writing till here in your books now. Let me go to the next part now. All right. So now I'll put a table particulars. Working note number 2, we will write down. I'll give a heading called as analysis. Particulars. You have 21-22. Sale has come down to the previous year. So the previous year will be what? 2021, correct? 2020-21. 2021-22. Okay. So I'll write down point number A, units. Decrease to 1 lakh as compared to 1 lakh 20. So here it is 1 lakh 20,000. Here it is 1 lakh. Point number B, selling price stood at 15 and the variable cost 10 for the both the years. Selling price 15. From this, can I find out the total sale value? 18 lakhs. 15 lakhs. Variable cost 10. 10. Total variable cost will be 12 lakhs and 10 lakhs. Friends, once you get the selling price and once you get the variable cost, can I go and find out the contribution now? What is my contribution? 6 lakhs, 5 lakhs. Everybody clear with this part? E, F, G. Fine. So now you got the answer as 6 lakhs and the other one you got the answer as 5 lakhs. Everybody clear with this part? Next point. Let me come to the next point. Contribution is 6 lakhs and 5 lakhs. Down they have told fixed cost is 2 lakhs. So once you get the fixed cost, from this you will get the EBIT. What is the EBIT that you will get over here? Will you get the answer as 4 lakh in the first place and 3 lakh in the second place? Correct? 4 lakh and 3 lakh. Selling price stood at 15, variable cost 10, fixed expense 2 lakh, income tax rate is 30%. On this you will have interest rate. How much will be the interest rate we found out over here, right? What was the interest amount? 2 lakh rupees, correct? Once you reduce this, you will get what? You will get the EBT. That will turn out to be 2 lakh. 2 lakh and here you will get the number as 1 lakh. Once you get the EBT, from this I will have to reduce the tax rate. Everyone tell me what is the tax rate that you have over here? 30%. Last one will be earnings after tax. That will be 1 lakh 40,000. Here you will get the number as how much? 70,000. Everybody clear with this part? Fantastic. Can you please put up this income statement in your books now, all of you? Yes, friends. Are you all done writing till here in your books now? All right, friends. Once you're done writing till here in your books, I think we have got the data. Now let us see what they are asking. They're asking you to find out the financial leverage for 1 lakh 20, 1 lakh. Operating leverage for 1 lakh 20, 1 lakh. Percentage change in EPS they are asking. So hold on. Once you get this, after you get L, can I find out M over here? M will be number of shares. Have you already got the number of shares over here? I think you got 20,000 shares, correct? Now tell me, friends, what is 1,40,000 divided by 20,000? Do you get the answer as 7 rupees per share? And here you are getting the answer as 3.5 rupees per share. They're asking you what is the fall in the EPS is how much percentage? 50. From 7, it is falling down to 3.5. So 3.5 divided by 7, you get the answer as how much? Minus 50 percentage over here. Everybody clear with this part now? All right, so like that, we have got the analysis part is cleared now. So after this, they want you to find out the degree of operating leverage and financial leverage. Let me find out here itself. So I'm writing N DOL. What will be the formula for degree of operating leverage? F contribution divided by EBIT. F divided by H. So when you do F divided by H, it will be 6 lakh divided by 4 lakh, 1.5. And what about the other one? 5 lakh divided by 3 lakh, 1.66. Everybody clear with this part now? So you got 1.5 as the answer for the first one. Now the second one would be EBIT divided by EBT. So EBIT is 4 lakh divided by 2 lakh. 4 lakh divided by 2 lakh. That will be H by J. 4 lakh by 2 lakh is 2 and other one is 3. Here you will get the answer as 2. This one will be 3. Once I get this, can I also find out the degree of combined leverage? That is nothing but DOL into DFL. So I think you'll get the number as 3 over here. And here you will get the answer as 5. All right, friends. So I believe all of you are done writing till here in your books now. Please write down this and finish it off. I think we are done with this question. Shall I just go and check? Check the requirement. They got the same thing. 2, 1.5, 3, 1.67. Yes, yes. Perfect. We've got the right answer. Write down and finish it off. We are done with this question also. All right, friends. So we are done with this question also. Can we go to the next question now, friends? I hope the pace is comfortable to all of you. Question number 6, ODB book. Question page number 8. The main purpose of this question is financial leverage, operating leverage. Every question we start with what? Working note number 1. Basic data. Earnings after tax. Earnings after tax is 5% on sales. Therefore, income tax rate is 50%. Pooja, you want the important theory of all chapters? I have already recorded important theory. Just WhatsApp me. I will arrange an access for that, but there will be a small prize involved for that. I'll just check that and give it to you. These 5 days are purely problem driven marathon, Pooja. Okay? Right. Can we do it now? So you have 5% on sales, income taxes 50%. Point number C, degree of operating leverage 4 times. 4 times. 10% debenture in capital structure 3 lakhs. 3 lakhs. Okay. Next one. Variable cost 6 lakhs. Variable cost 6 lakhs. From the given data, you want to complete the following statement. Beautiful question, friends. Calculate the financial and combined leverage. Calculate the percentage change in EPF. Okay, basically they have given you some data. From this data, they want you to do a backward working. So friends, what I will do here is I'll write down working note number 2, analysis. Particulars, computation, last column heading is going to be result. Okay. So now everyone interact with me. In this, I'll write down the first part. What is the first thing they have told over here? Earnings after tax is given as 5% of sales. They have not given the sales. I'll put sales, variable cost, contribution. Then you will have fixed cost. Then you will have EBIT, less interest. Then you will have EBT. And from EBT, what will you have? You will have tax. Once your tax is done, you will get your EAT or earnings after tax. Here, if I put the number of shares, I will get the EPS. This is the format. Am I right? Now, once I put the format, sales, how much they have not told us. Can I put the value of sales over here as X for time being? They have told variable cost is 6 lakhs. If that is the case, can I say the contribution will be X minus 6 lakhs? Fixed cost, have they told? No, they haven't told. But they have given you the degree of operating leverage as how many times? 4 times, or nothing but contribution divided by EBIT is given as 4 times. So from that I can do a reverse working to find out if that is the case, my EBIT will be nothing but contribution divided by 4. Am I right? So I'll get the number over here as 0.25x, that is x divided by 4, divided by 6 divided by 4 will be 1.5 lakhs. So in between this, you will have a fixed cost. What is the fixed cost that you will have in between? $4,50,000. Okay. Now you will have the interest. So what is the interest they have told over here? 10% debenture, 3 lakh is the debenture value. So interest will be 30,000. So once I reduces my EBT will be 0.25x minus 1.80 lakhs. Am I right? Yes. And then I think tax is given. Have they given the tax rate? 50%. So of this 50% will be 0.125x minus 0.9 lakh. And my EAT will be 0.125x minus 0.9 lakhs. My dear friends, this is a crazy question. Now they have told this EAT is nothing but it is turning out to be how much percent of sales? It is turning out to be 5% of sales. First, you do one thing. Can you write down till here in your books now? Leah, I'll tell you how I got the fixed cost. Now, when you're telling me, I'm also getting confused. How did I get that? I got this as x minus 6 lakhs. Down I got EBIT as 0.25x minus 1.5 lakhs. Is it given in the question fixed cost? No, right? Wait. I think I've made a small mistake here. It is not just 4,50,000. Fixed cost is the difference between EBIT and contribution. So it will turn out to be 0.75x minus 4.5 lakhs. Thank you for correcting me there, Leah. All right, friend. Are you all done writing till here in your books now? All right. Once you got this, now we know that 5% of EAT is equal to sales. So, isn't that what they have told in the question? Sales earnings after taxes 5% into sales. So, sales is X. 5% of sales will be how much? I think last two part I can avoid because it's not available anyways. So, can I form an equation over here that 0.05x is 5% of sale? This is nothing but 0.125x minus 0.90 lakhs. Yes or no? Or in other words, 0.90 lakh will be equal to 0.075x. Therefore, x is equal to 0.9 divided by 0.075. Do I get the value of x as 12 lakh rupees over here, friends? Please confirm if you are getting the same number. Perfect, friends. So I think we got 12 lakh as the answer. And once you get 12 lakh, I can do a reverse working again. Correct? So I'll put a table, particulars, computation, result. So in particulars, I'll write down sales. What is the sale value that you get over here? Is it 12 lakhs? Variable cost is how much? 6 lakhs. Therefore, your contribution will be how much now? 6 lakhs. Then you have fixed cost, you have EBIT. They have given in the question the operating leverage is 4 times. So this will turn out to be 1.5 lakhs and your fixed cost will turn out to be 4.5 lakhs. Yes or no? So that's the same answer I got earlier, is it? 1 minute. Yes, that's the same answer, 4.5 lakhs. Once I get this, I will put the interest amount. Do we know the interest amount over here? 30,000. So once you reduce this, you get your earnings before tax. That will be 1.2 lakhs. Of this 1.2 lakhs, you will have a tax at the rate of 50%. That is 0.6 lakhs. And your earnings after tax will turn out to be 0.60 lakhs. So that is nothing but 5% of 12 lakhs. All right. Can you write down this and finish it off, friends? We are done with this question also. Yes, friends. Are you all done writing till here in your books now? So we are done with this particular concept or this question also. Fantastic, friends. So we are done with this question. I think we got the answer as 12 lakh. Yes. Perfect. Can we go to the next question now, friends? Are you feeling tired? All right, let me go to the next question now. Question number 7, ODB book. ODB book. Shall we begin now, friends? All right. So in this ODB book, question this data they have given us 86 lakhs. So I'll write down working note number 1. Working note number 1, basic data. In that I'll write down point number A. What is point number A? Sales. So what is the sales value that you have over here? 86 lakhs. Point number B, they have given you the PV ratio. Now tell me what is the PV ratio that you have over here? Is it turning out to be 35%? From this, can you find out the contribution now? Will that turn out to be 30 lakh 10,000? Contribution is 30 lakh 10,000. After that, you get the fixed cost. What is the fixed cost that you have over here now? Everyone tell me. Fixed cost is going to be 10 lakhs. 10 lakhs. All right. Once you reduce the fixed cost, do you get the EBIT over here? How much is your EBIT that you get over here? Do you get the answer as 20 lakh 10,000 rupees? 20 lakh 10,000 rupees. Next part. Once you get this as 20 lakh 10,000 rupees, I will go to the next part. One moment. 20 lakh 10,000 rupees. Next part, they have told about 1 minute EBIT. Then it is interest. Interest is given over here. Fixed cost is given excluding interest, correct? 10% debt is 55 lakhs. So 5 lakh 50,000 will be the interest. Once you reduce the interest, do you get the EBT then? That will be 14 lakh 60,000. EBT will be 14 lakh 60,000. Once you get the EBT as 14 lakh 60,000, next part is we will have to put the taxation. Tax is going to be 40%, 5 lakh 84,000, 5 lakh 84,000. Once I reduce this, I will get the earnings after tax. Do you get the answer as 8 lakh 76,000 rupees? Everybody clear with this part? All right. Have they given the number of shares? Yeah, 75 lakh capital of 10 rupee each. So from that we can get the number of shares. 75 lakh capital of 10 rupee will be 7 lakh 50,000 shares. From this I will get the EPS also. What will be the EPS I get over here now? Do I get the answer as 1.168 rupees per share? Everybody clear with this part now? All right. Can you please write down till here in your books now? All right, friends. I believe you are all done writing till here in your books now. Now let's read. Determine the company's ROE, pre-tax and EPS. Return on capital employed. We learned that in the chapter of ratio analysis, but right now I'll write down over here. Return on capital employed, ROCE. So when you say return on capital employed, ROCE, what we will do over here is we'll write PAT or profit after tax. Am I right? So capital employed, what is the profit after tax that we got over here? Capital employed means it is for both equity and shareholders. So I need to take the EBIT into 1 minus tax. EBIT, but they are telling pre-tax. Am I right? Pre-tax. So it will be EBIT. The formula will be EBIT. So how much is the EBIT over here? 20 lakh, 10,000. Divided by what, friends? Capital employed. So what is the capital employed that you have over here now? Can you tell me? That is equity plus 55 lakh and 75 lakh. 70, 125 lakh, 130 lakh. So now tell me, friends, if that is the case, what will be your ROC that you get over here? Do you get the answer as 15.46%? Shall I cross check this with the solution, friends? Correct. We have got the right answer over here. Can you all please write down till here in your books now? All right, so we have got ROC. First question is over. Can we go to the second question? Does the company have a favorable financial leverage? Now, friends, how do you find out the financial leverage? EBIT divided by EBT, correct? So, what is EBIT divided by EBT? Do you get the answer as 1.37 times? This is one way of looking at it, or the logic is that for every 1 rupee of EBT, you have 1.37 rupees of EBIT. There is one more way of looking at it. What is the ROC you got over here, friends? Everyone tell me. The company has got an ROC of 15.46. What is the actual interest cost of the company? Everyone tell me. How much is the interest cost of the company? Is it turning out to be 10%? So this means I can borrow 100 lakh at 10%. I can invest that in my company at 15.46%. I will get a profit of 5.46%. Am I right? So I'll write, since my ROCE is greater than my interest cost, ROCE is greater than my interest cost, I have a favorable financial leverage. Everybody clear with this part now? I have a favorable financial leverage. Are you all clear still here, friends? Perfect. Now I'll go to the next question. Calculate the operating and combined leverage of the company. Friends, that and all we can do it here itself. I'll write down below this E, degree of operating leverage. So that is 30 lakh 10,000 divided by 20 lakh 10,000. You'll get the number as 1.49. 20 lakh 10,000 divided by 14 lakh 60,000 will be 1.37. And the degree of combined leverage over here will be 1.49 into 1.37, that is 2.04. Everybody clear with this part? 2.04. Now next part. Operating leverage, combined leverage we have found out. calculate the percentage change in EBIT if sales increases by 10 percentage. Wait, friends, are you all clear so far? I'll give you 1 minute. Write down till here, then I will go to the next part. All right, friends. I believe all of you are done writing till here in your books, friends. Perfect. All right. Now they are asking you what is the percentage change in if sales increases by 10%, what will be the change in EBIT? Friends, we have learned a formula percentage change in EBIT divided by percentage change in contribution, right? Contribution by EBIT. This is nothing but the operating leverage. That same formula applies to sales also. Am I right? This formula we know is equal to operating leverage. We got the operating leverage as how much, friends? We got the answer as 1.49. Am I right? So now what will happen is when you are trying to solve this, your percentage change in EBIT, other one is 10%. So can I say percentage change in EBIT divided by 10 percentage is equal to 1.49. So when you do a reverse working, therefore, can I say my percentage change in EBIT will be nothing but 14.90 percentage, friends? Leah, capital employed includes equity, preference, and debenture. In this question, there is no preference share. Preference is also a part of capital employed, Leah. You should take that also. What is ESC, Leah? I didn't follow that. You take only equity when you're talking about ROE, return on equity. When the word is ROCE, return on capital employed, you take equity, debt, preference, everything. All right. So did you get the answer as 14.9 percentage? Let's go and check. Yes, they have also got the answer as 14.97 percentage. Everybody clear with this part now? Now let's lead the last part of the question. At what level of sales the EBT of the company will be equal to zero? Beautiful question. Friends, percentage change in EBT divided by percentage change in contribution or sales. If you put it the other way around, it is what? It is basically contribution divided by EBT. That is combined leverage. Correct? What is the combined leverage that you already have in your books? Is it 2.04? Now they are telling what should be the level of sales so that EBT can become zero. Friends, for EBT to become zero, the change in the EBT should be 100% or 100% divided by percentage change in sales should be equal to 2.04 percentage. Everybody clear? Therefore, percentage change in sales will be equal to 100 divided by 2.04. Do you get the answer as 49 times over here now? Can I just check this answer also over here, friends? Yes, they have got 48.5. It's just the rounding of difference. So the new sales they get as 44.29 lakhs. Because the current sales is how much? Current sales is 86 lakhs. So we are done with this question also. Friends, I think you're all getting exhausted. We have done a 2.5 hour session and we have covered 2 chapters in this 2.5 hours, friends. What I'm thinking is, shall we take a break now? You take some rest. Night at 10 o'clock, shall we start again 10 to 11:30 and we finish off one more chapter? Cost of capital. I think that will be much better. I think going at a stretch for 5 hours is something exhausting for all of you. Let me know how you are comfortable. Accordingly, we can do it. Are you all comfortable so far? Whatever I have taken, friends. This is an exhaustive revision. What I teach you, you do it and you go to the exam hall, you will be able to crack all the questions there. But I want things to be very comfortable and it should not affect your other routine also. If 5 hours a day is difficult, we can do 2.5 hours a day. It will take just extra 3-4 days extra. You can study other topics during that time also. But I want it to be effective. Very, very important for me, friends. Please do give me your feedback. Accordingly, we can plan it. Leah, you have asked a question on WhatsApp with it. We'll definitely solve that, Leah, for sure. Okay. But I'm just feeling that everybody is a bit drained out. And can we do it? We'll do one thing. Can we do it night 10 p.m.? What is your plan at 10 p.m.? Are you free to attend the class at 10 p.m.? We can sit from 10 to 12. 2 hours again we'll sit. That time we'll do this RTP question. We'll do the remaining problems also. What's your suggestion? Students are getting tired and I think they are coming down. The number is slowly coming down. Let's do one thing. Let's try a session today night. I'll come to know how you are feeling about this. 10 is fine, right? So I think that will be better, I think, rather than me draining at a stretch 5 hours. It might be a little bit tiring for all of you also. We'll do next session from 10 to 12. We'll start off with the RTP question, Leah. Okay? Fantastic. All right, friends, I'm wrapping up my session now. Take some rest. Get back at 10 o'clock. We'll sit again and we'll wrap up everything else. Okay? Thank you so much. Have a nice time ahead. Take care. Thank you.